How's it going, YouTube? My name is Christian with Plan Your Federal Retirement, back with another video, and this is our Critical Concepts series. So one of the things I want to talk about today is related to health insurance, your FEHB. We often get asked from clients about questions around eligibility requirements for keeping FEHB into retirement, questions related for the spouse to keep FEHB into retirement, or God forbid, if you passed away, how can they keep their health insurance? We'll also get questions around Medicare. Should we be signing up for Medicare Part B as well as having our FEHB coverage? Really good questions. I feel like we're not asked often enough around what type of FEHB plan to be in. And that's what I wanted to talk about today. For a lot of our clients, they'll have a low deductible, high premium, higher premium per month plan that offers really robust coverage. And so when those medical expenses do come up, their out-of-pockets are, generally speaking, pretty low because they've got more or less that Cadillac health insurance plan. And if that's you, that's great. Often it's like a Blue Cross Blue Shield standard plan, right? And we've got a lot of clients that have that type of plan or equivalent. We'll see this often coupled with a flexible spending account, an FSA. A flexible spending account allows you to contribute pre-tax dollars, some dollars that we haven't paid tax on, and then be able to spend those dollars throughout the year on qualified medical expenses. And then when we do spend those dollars from our flexible spending account, it's tax-free as well. So pre-tax going in, tax-free on qualified medical expenses. A flexible spending account is a really good tool. Qualified medical expenses can include things like hospital stays, co-pays, prescriptions, glasses, contacts, medical equipment, different therapies, or even acupuncture. And the list continues to go on. There are numerous things that can be considered a qualified medical expense. Flexible spending accounts are designed so that you spend that money throughout the year and spend that money that you contributed throughout that year. For 2024, the most that you can put into a flexible spending account is $3,200 and $6,400 for a family if you're married. If you don't spend all of that money in 2024, then you can carry forward a total of $640 into the 2025 year. That would be the carry forward limit. In 2023, I believe it was $610. So it goes up a little bit every single year. So the important thing to note when it comes to a flexible spending account is, again, we have to spend that money throughout the year, and we do get to carry forward any unused, unspent balance into the following year, but it's really designed to be spent. The critical concept is to consider a different type of health insurance and accompanying account. This would be a high deductible health plan accompanied with a health savings account, an HSA. We're big fans of HSAs. They allow the person to contribute pre-tax dollars into the account, as well as spend that money on qualified medical expenses tax-free, just like a flexible spending account. The only main difference is that the health savings account is designed for more of that long-term savings. That money that we're putting into the account is not a use it or lose it benefit that has a $640 carry forward, that rather that money that you put in an HSA, you can actually invest it. You can invest it and buy, index funds and have it grow for many, many, many years. So in an HSA, the dollars that you put in are pre-tax. Then you get to invest that money and have those earnings be growing tax deferred or tax-free. And then when you spend that money in the future on a qualified medical expense, that also comes out tax-free as well. So pre-tax going in, growing tax deferred, and then tax-free for a qualified medical expense. It's a really, really good tool. We like the HSAs a lot for their tax savings that they have and that they offer. And in 2024, the contribution limit to an HSA is $4,150 for single and $8,300 if you're married or a family plan. If you're over the age of 55, you can contribute an extra $1,000. So a total of $9,300 for that family plan. So we think this is a often underutilized benefit, again, because we have to accompany it with a high deductible health plan. We no longer can have that low deductible health plan where our premiums are higher per month. We'll have to forego that and have to choose a high deductible health plan, which lowers our monthly premiums, but it does increase our out-of-pocket expenses for medical related expenses that come up throughout the year. One strategy that we really like with HSAs is, instead of any medical expense or qualified medical expense that might come up throughout the year, to use HSA funds to pay for that qualified medical expense, instead choose to pay that qualified medical expense out of pocket and then allow that HSA to continue to grow. Keep the receipts, right? Use an outside account that's not an HSA, like a bank account, checking or savings account, to pay for that qualified medical expense. Keep the receipts and accumulate these receipts so that in the future, you can reach into that HSA and take out a lump sum and reimburse yourself for past qualified medical expenses that you had paid out of pocket. This is allowed inside of an HSA. Once you're the age of 65 or older with an HSA, you can no longer contribute new dollars into the HSA, but the account is still yours. It's still your HSA that you can continue to invest and grow or spend that money. At age 65, another unique thing happens, which says that we can now use that money not only for a qualified medical expense, but really any expenses in general. If at age 65, we choose to spend the HSA dollars on qualified medical expenses, that is the same tax treatment I mentioned before: pre-tax going in, tax deferred growth, tax-free coming out to pay for a qualified medical expense. But at age 65, if we choose to pay for something that's not a qualified medical expense using an HSA account, then it's treated similar to a traditional IRA or a traditional TSP, where it was tax-free dollars going in, tax deferred growth on the investments, and then 100% taxable when you go to spend that money. So it's not a bad strategy, even if that was going to be the plan, to treat it as more or less another account that you have access to in retirement years for either it be medical expenses that are tax-free, or past medical expenses that you had kind of been saving up those receipts for, or you can treat it more like a traditional IRA or traditional TSP, where it's going to be taxable to you when you take those dollars out. Again, as I mentioned, HSAs have to be combined with a high deductible health plan. So that might take a little bit of getting used to, especially if you had been used to for many years paying for a higher premium plan with a low deductible plan, and therefore your yearly out-of-pocket related medical expenses are lower. It might take some getting used to now pay less per month, and then whenever those medical expenses come up, paying out-of-pocket quite a bit more. But it's not right for everybody. That is in a high deductible health plan with an HSA, but it could be for you. So it's one thing to be considering. You got to look at your cash flow situation. You got to be looking at what your anticipated medical needs are for throughout that year. But if it is something you're considering, maybe look at it this upcoming November during open season. So hopefully this video was helpful as we went through that critical concept, talking about HSAs versus flexible spending accounts, and how HSAs are very underutilized that we see in the federal space, in the FEHB space. If you have questions related to this, feel free to leave your question below in the comment section. Make sure you're subscribed to our channel so we get our latest videos and content that we're putting out. And until next time, happy planning.